Today we're going to be talking about buy versus lease. I'm Karen Johnson. I'm an investment broker with Next Stage Legacy Realty and also the principal with CareTech Commercial Investment Solutions. The dilemma of deciding whether to lease or buy real estate is a question often encountered by many companies. Different economic climates, rental rates, and current sales can drive different situations for organizations that are in the market looking for space. While every business is different, there are a few common factors that should be taken into consideration when evaluating whether to buy or lease space. To start, let's look at opportunity costs. With a large outlay of capital required to purchase office space, the opportunity cost of that capital and alternative uses needs to be factored in. To emphasize, if funds are to be used for a purchase, has the organization decided on an acceptable rate of return or a safe rate for their investment, and what do they expect on that money compared to the return they would expect to receive if they invested that money back into the business or in other investments? Another one is growth considerations. Is the company rather new and/or in a high growth mode? Is the company mature or stable? Is there a significant specialty use? The growth phase of a business should be a major consideration in making the lease versus buy decision. If your company is relatively new and/or in a high growth mode, leasing can provide more flexibility and fewer constraints to that growth. On the other hand, if your company is mature and stable, or you have a significant specialty use that could adversely affect your lease tenancy, then buying space is a great alternative to meeting your future needs. And lastly, we want to look at the long-term business plan. Your strategy should match the long-term business plan of the company. Those types of decisions require proper planning. Now we're going to break down some benefits to buying, and that is the mortgage interest is tax deductible. You know what fixed operating costs are going to be based on your specific site needs. You can take annual depreciation on taxes. No annual increases. You can benefit if you sell when it is in a strong market and your property is appreciated. Earn income from leasing excess space. Changes could be made to the building to accommodate your specific business. And there's no restrictions on hours of business operation. And the location of your business will remain consistent. And you can take a line of credit against your property to make improvements. And two, it'll offer a stronger sale to your business if you include real estate. And the ability to defer capital gains tax into deferred tax exchanges or structured sales. Now we're going to look at some of the disadvantages to buying. It usually requires more initial capital to secure financing. Property value may decline. You're subject to the owner to having additional insurance as an owner because, again, you might have some legal or safety or regulatory risks. There's more time and energy to managing the property, so at times it might make sense to hire a property manager. And then too, with it as an experienced owner, you might have some extra operating cost because of some of the inefficiencies if you're just getting started. There might be an increase in property taxes and management costs and upkeep, and for some there might be an adjustable loan. Now we're going to look at some of the benefits of leasing. Now, when you lease, you don't have the worry of selling if you're moving to a new location. The monthly rent is tax deductible as a business expense, and you have the flexibility to sublet or move if needed at the expiration of the lease, and no loss if owning in a bad market. There's less cash investment up front, more cash available for expansion, and you know what expenses will be because it'll be stated in the lease. Then we're going to look at some of the disadvantages to leasing. And that could be rental rates with annual escalation clauses based on market conditions. There might be a loss of value with any remaining capital investment or improvements that you put in at the end of your lease. There might not be any equity buildup or appreciation of the value of the property. And you may be forced to move at the end of the lease. And there might even be some contractual penalties. And of course, you're subject to the landlord or property manager's operational control. The bottom line, you must have a strong understanding of all financial implications pertaining to your business. Analyze every element of the situation, including programmable space needs, in the current environment as well as 5 and 10 years out, the cash flow, your future projected expenses, expectations for rental increases and property value appreciation, interest rates, management costs, and taxes. Now, what would be the best outcome? Or maybe the expected outcome? Or the worst outcome? Well, that's where you want to do an analysis. And we do offer a free analysis. You do the bottom, well, to finalize, we want to consider where you want to take your business. So plan for the end in mind. Now, again, we talked about a free analysis. You're more than welcome to give me a call. This is again Karen Johnson. My number is 303-470-1947. You can email me Karen@caretech.com, and there's a website called commercialinvestmentsolutions.com too. Thank you.